Well, good morning, Jagender Rana here. The topic of the day is average clause in fire insurance. Average clause in fire insurance. So, fire insurance is a type of insurance that covers your property against losses or damages caused by fire and its allied perils. So, fire insurance is vital for property owners in India as fire incidents are pretty common and can result in substantial financial losses. So, when you buy a fire insurance policy, you must declare your property's value to the insurance company. This value is the sum insured and the maximum amount the insurance company will pay you in case of a fire loss. However, the sum insured may not always reflect the actual value of your property at the time of fire incident. So the actual value of your property is the market value or the replacement cost of your property, depending on the type of policy you have. Under insurance is the term used to describe the discrepancy between the sum insured and the actual value of your property. So the amount of loss or damage that you suffer due to fire is called the loss amount. The average clause in insurance is a provision that applies when your property is undervalued or underinsured at the time of policy purchase. It affects the claim settlement in case of a partial loss due to fire. The partial loss is when your property is not destroyed by fire but only partially damaged. So under the average clause, the insurer applies a reduction factor to your claim amount based on the degree of underinsurance. The concept applies to most fire insurance policies unless otherwise specified. It is also known as the pro rata condition of average or the underinsurance clause. To understand how the average clause affects your claim settlement, let's take an example and use a formula. Suppose your property is worth rupees 50 lakh, but you have insured it for rupees 40 lakh only. That means you are underinsured by 20%. 10 upon 50 into 100. So suppose a fire breaks out and causes a loss of rupees 20 lakhs to your property. So how much will you get from the insurance company? The answer is not rupees 20 lakh, but rupees 16 lakh only. That is because the average clause will apply and reduce your claim amount by 20%. So here is the average clause formula to calculate the claim amount. The claim amount is equal to sum insured upon actual value of the property into loss amount. I repeat, claim amount is equal to sum insured upon actual value of the property into loss amount. So the claim amount is 40 upon 50 into 20. So claim amount is 0.8 into 20 lakh means 16 lakhs. The average clause in fire insurance implies that you must bear a part of loss reflecting the extent of your underinsurance. In this example, you must pay rupees 4 lakh from your pocket in addition to the premium you already paid. So the average clause in fire insurance and the burglary insurance is necessary because of certain reasons, that it discourages underinsurance and encourages adequate coverage. The average clause ensures that the insurance company does not pay more than the proportionate value of the property in case of a partial loss. It prevents the insured from profiting from the insurance claim, which would otherwise create a moral hazard. So a moral hazard is a situation where the insured has an incentive to cause or exaggerated loss because they can benefit from the insurance claim. So the average clause also ensures that the insured pays a fair premium for the coverage they receive. The premium amount is based on the sum insured, which should reflect the property's actual value. If the property is underinsured, the insured pays a lower premium than they should, which is unfair to the insurance company and other policyholders. So the average clause corrects the imbalance by reducing the claim amount in proportion to the degree of underinsurance. Now the question is how to avoid the average clause in fire insurance. The best way to avoid the average clause in fire insurance is to insure your property for its total value. However, assessing the property can be challenging, as the property value may change over time due to depreciation, appreciation, inflation, renovation, or market fluctuations. These are the most common reasons what I am narrating: depreciation, appreciation, inflation, renovation, and market fluctuations. So, how you can prevent common issues in fire insurance policies? You can consult a valuer, an architect, or an engineer to help you determine the accurate value of your property. So the expert can also advise you on the type of policy and the average that suits your property and needs. You can use calculators, estimations, or comparators to help you estimate the value of your property. These tools can provide you with a range or a benchmark of the property value based on various parameters such as location, size, age, condition, and property features. However, they may not be updated or accurate and may not reflect your property's specific characteristics. So update the valuation regularly. You must update the valuation of your property regularly, at least once a year, or whenever there is a significant change in your property, such as renovation, extension, or improvement. This will help you adjust the sum insured and the premium amount accordingly and avoid underinsurance or overinsurance. So review the policy terms. You must thoroughly review the terms and conditions before purchasing or renewing a fire insurance policy. Or check the policy for exclusions, limitations, or endorsements that may affect the claim settlement. Now, how is the average clause different from other clauses? See, an average clause differs from the restatement value clause and the agreed value clause, except that they all influence the claim amount. The reinstatement value clause states that the claim amount will be based on the cost of restating or rebuilding the property. Rebuilding the property rather than its market value. So that means the property's depreciation or wear and tear will not be deducted from the claim amount. However, this clause may also include the average clause, reducing the claim amount if the property is underinsured. So the agreed value clause states that the sum will be based on the property's predetermined or agreed value rather than its actual value. That means the claim amount will not be affected by the property's market value fluctuations. Nevertheless, this condition may result in a higher premium as the insurance company takes on more risk. So fire insurance policy protects property owners in India from the financial impact of fire accidents. However, the average clause makes claim payment tricky as it requires accurate property valuation. If the property is undervalued, you as an SME business insurance policyholder or the shopkeeper or even a corporate will get less money and have to pay more from your own pocket. So the clause is fair as it discourages underinsurance, prevents overclaims, and keeps premium stable. To avoid problems, you should get expert advice, use online resources, and update your property value regularly. You should also learn the differences between other clauses such as reinstatement value and agreed value to better understand your cover. Now, you must understand that an average clause in a fire insurance policy addresses underinsurance. If the assets are insured for less than their full value, the insured must pay a proportion of the loss according to the policy's average clause. Since a fire policy is an indemnity contract, the insured cannot claim more than the actual value. So the insured must pay the difference if the actual value of goods or property is higher than the insured amount. If there is a difference between the insured amount and the actual value, the insured covers this difference. Insurance companies only pay a proportionate share of the loss. Average clause apply when the actual value of the goods or property is less than the insured amount. It is essential to understand the calculation of the average clause in fire insurance in order to determine the liability of the insurer for the reimbursement of the claim. Now, the average clause formula that the insurer generally uses to determine the value of an insured claim could be denoted as the insured claim amount is equal to actual loss into insured value upon actual value of the property. This can be presented in this way also. Insured claim amount is equal to actual loss into insured value upon actual value of property. So in the average clause formula mentioned above, the actual loss refers to the loss that has been incurred by the insured during the occurrence of fire. Insured value refers to the value for which the insurer purchased the fire insurance. And the actual value of the property refers to the total value of the property at the time or day of fire incidents. So the actual value is determined after applying the appropriate depreciation on the insured property. So let us see a case study in order to see how the average clause in fire insurance is determined. One gentleman, Mr. Dev, the 45-year-old businessman, owns a factory manufacturing garment which he caters to the shopper for business purposes. One day during the operation of a business, a fire engulfed his factory where he lost the stocks of garments that were ready to sell. So he approached the insurer of fire insurance online and claimed the loss. The surveyor found the average clause in the fire insurance policy and discovered the value of the claim as follows. Actual value 4 lakh, sum insured 3 lakh, loss incurred 2 lakhs. Now since half of the stock caught fire, hence on the basis of the average clause in insurance policy, the surveyor determined the claim value by applying the formula mentioned above. And the formula is insured claim amount is equal to actual loss into insured value upon actual value of property. Means 2 lakh into 3 lakh upon 4 lakh. So the insurer is liable to pay rupees 1,50,000 while the insured has to bear the loss of 50,000. So to avoid the average clause in fire insurance, the best approach is to insure your property for its full value. However, accurately assessing the property's value can be challenging due to factors like depreciation, appreciation, inflation, renovation, and market fluctuations. So the average value clause applies to policies based on the property's market value, accounting for depreciation. The reinstatement value clause applies to policies based on the replacement or repair cost of the property, unaffected by depreciations. So now while the insurance frequently uses the average clause, it can also be applied to other types of property insurance. This clause is especially common in policies where the insured value significantly affects the settlement. Although predominantly found in fire insurance, similar principles may apply in other property insurance contexts to prevent underinsurance and ensure fair compensation for partial losses. Say, for example, engineering policies. All engineering policies almost are subject to underinsurance. Burglary policy is subject to underinsurance, like that. So insuring your property for a higher amount might result in a greater claim amount in the event of a partial loss, but it is essential to do so accurately and transparently. Overvaluing the property to manipulate the claim amount can lead to policy violations and potential denial of claims. But to avoid such issues, it is crucial to genuinely assess the property's value and ensure it is adequately covered. Certain insurance policies include endorsement or clauses that modify the application of the average clause. Sometimes the average clause may not be strictly enforced for specific high value items or specialized coverage. So to understand when the average clause might be modified or excluded, it is essential to carefully read your policy, documentation, and consult your insurance provider. Thank you. Thank you very much.